Welcome to this presentation on emerging economic and market scenario. As I speak to you today, in early November 2017, stock markets are extremely bullish. The Sensex year to date, from January 1st to November 1st this year, is up by 28%. Nifty is up by 31%. Nifty mid cap is up by 47% and Nifty small cap is up by 52%. Many stocks have doubled and tripled. Mutual funds have given excellent returns. So investors have benefited substantially from this bull run. But there is an area of concern, and this concern is about market valuations. If we go by the traditional metrics of valuation, the price earning multiple, valuations are a bit excessive. During the last 25 years in India, from 1991 till 2016, the trailing PE multiple, the trailing price earning multiple, has been around 80. That is the historical average during the last 25 years. Presently, the trailing earnings PE multiple is around 26. This means presently the valuations are 50% higher than historical valuations. This is an area of concern. Particularly in some segments of the small caps and mid caps, there are bubbles. Valuations in some segments are hard to justify. Even in the IPO market, there is overconfidence, euphoria, and some irrational pricing. In this circumstance, investors are a little bit worried. What should investors do under the circumstances? Let us get the issue in perspective. First, we have to understand that the present bull run is a global bull run. It is not a phenomenon confined to India alone. Globally, the stock markets are extremely bullish. The Morgan Stanley Capital International All Country Index is up by 12% this year. The Morgan Stanley Emerging Market Index is up by 23%. As you can see, some countries like China and Argentina have done better than India. South Korea and Brazil have done as well as India has done. Therefore, this is not a bull run confined to India alone. This is a global rally. So the question is, what is powering this global rally in stock markets? The simple answer is, there is synchronized global economic recovery. It is the synchronized global economic recovery that is powering the stock markets globally. We had a long period of turbulence in global economy. From 2008 to 2016, we went through almost 9 years of global economic turbulence. In 2008, we had the global financial crisis and the meltdown in the global stock markets. In 2009, the global economy fell into the worst recession since the Great Depression of the 1930s. Then in 2010 and 2011, global economic growth and financial markets were deeply impacted by the European debt crisis. Then in 2013, what we now call the taper tantrums impacted global markets. So there was that currency crisis in emerging markets. Indian currency was also very severely impacted by the emerging market crisis of 2013, emerging market currency crisis of 2013. Then in 2014, there was the global commodity crash. global commodity crash in the prices of crude, metals, etc. impacted international trade and adversely impacted global economic growth also. Then in 2016 we had the Brexit, and in India we had the demonetization, which also impacted economic growth in India. So after almost 8-9 years of global economic turbulence, now we are witnessing a synchronized global economic recovery. As you can see from the chart, global economic growth in 2017 is expected to grow from 3.1% to 3.4%. And the estimates are that by next year, 2018, global growth will rise to 3.4%. US is growing fast, Europe is stable, and emerging markets as a group are doing exceedingly well. So it is this synchronized global economic recovery that is powering stock markets globally. In India, of course, we have our unique economic circumstances. In India, what we are witnessing right now are a series of reforms. Which aim at resetting the Indian economy. It started with demonetization. Now we have implemented a major structural reform, a very big reform in the form of a GST. Along with that, the government has implemented the Real Estate Regulation Act, and there is the Aadhaar-linked direct benefit transfer. The Benami Property Acquisition Prevention Act has been passed, and recently we had the bankruptcy code also, insolvency and bankruptcy code. All these reforms aim at resetting the Indian economy and transitioning the Indian economy to a more transparent, formal economy. The consequence of these reforms will create some major trends in the Indian economy. Two major trends that are happening in India now. What I would like to call two mega trends in the Indian economy are: one, the formalization of the economy, that is the direct consequence of demonetization, and also the implementation of the goods and services tax. The informal sector is shrinking and will progressively shrink going forward. So the formal sector of the economy will expand. This is the formalization of the economy. And secondly, from the capital market perspective, a major reform is, a major trend, a mega trend is the financialization of savings. Till recently, 65% of the gross domestic savings in India went into investment in physical assets like gold and real estate. What we are witnessing now is a transition from these physical assets progressively into financial assets. And within financial assets, stocks and mutual funds are becoming, increasingly becoming a preferred asset class. The reason why it is becoming a preferred asset class is, one, investments in stocks have big tax advantages. Dividend income up to rupees 10 lakhs are completely exempt from tax, and long-term capital gains are completely exempt from tax. In the case of mutual funds, equity mutual funds and balanced funds, dividends are completely exempt from tax, and long-term capital gains are also completely exempt from tax. This is a very attractive advantage, and to take advantage of this unique tax break, a lot of money is coming to equities directly as well as to the mutual fund route. So the inflows into the mutual funds has increased substantially. Another reason for this accelerated inflow into mutual funds and equity markets is that other asset classes like bank deposits, gold, real estate, etc. are becoming unattractive. Gold has not given any return during the last 5 years. Real estate has become a very illiquid asset class, very difficult to sell, and prices have even started correcting in certain pockets. And the interest on bank deposits is very low, 6.75% for 1-year deposits, barely sufficient to cover inflation. So when these competing asset classes are becoming unattractive, stocks and mutual funds are becoming very attractive. This is the reason why a lot of money is coming into the markets, and this liquidity is playing a major role in keeping the markets very buoyant. And this trend of financialization of savings, and within the financialization, increasing preference for equity and mutual funds is a trend which will gather momentum going forward, and it is likely to be an entrenched trend. We have just begun this journey of financialization of savings and capital flows into the capital market. So in this context, and also in the context of India's very attractive growth prospects, it is quite possible that Indian stock market can have a higher valuation than the past. So I refer to the 18 price earning multiple, trailing earnings, 18 times trailing earnings. So we can have a new normal where it can be higher than 20%. But presently it is 26 on the higher side. But even this 26 will appear attractive if the expectation of growth materializes in the next year. This year, corporate earnings are likely to grow by around 8%, but then we are likely to witness a major turnaround in economic growth and corporate earnings in 2018-19. 2018-19, if we succeed in achieving 20% corporate earnings growth, which is very much within the realm of possibility, then Nifty earnings will be around 600. With Nifty earnings at 600, with a PE ratio of 12, and Nifty of 12,000 can be justified. So it's quite possible that Nifty can be at 12,000 in a growing economy where the corporate earnings also increase in the next year. This is very much within the realm of possibility. But if that does not happen, then this hope trade may be impacted, adversely impacted. There can be a sell-off leading to a correction of maybe more than 10%, will be higher than that. But then there are leading indicators signaling that economic growth is likely to accelerate going forward. So in this environment, what should be the ideal investment strategy? The ideal investment strategy for investors? Well, since a lot of money is going to come in future also, blue chips will be in huge demand. Therefore, let me explain this in terms of do's and don'ts. The do's are: remain invested in blue chips, remain invested in large caps, quality large caps. Remain invested in mid caps. There are many quality mid caps. The price may be slightly on the higher side, but remain invested in mid caps. Investment in small caps should be done with extreme care and caution. Ideally, investment in small caps should be done through the mutual fund route. That also not through bulk investment, but through systematic investment plans. Avoid bulk investment in small caps. There are many small caps which are being driven by momentum, being driven by speculation, being driven by tips and rumors. Investing in such stocks will be extremely dangerous. So our investment strategy should be based on cautious optimism, We can be optimistic about India's future growth prospects. At a buoyant market, we should be concerned about valuation. So small caps, bulk investment in small caps should be avoided as much as possible. Small cap investment should be done through the mutual fund, through the systematic investment plan. If some investors want to invest in bulk, if they are very particular about bulk investment, well, bulk investment can be done through the systematic transfer plan, where money is invested in liquid funds, and periodically every month money can be transferred into equity funds or balance fund to the systematic transfer plans. So that should be the investment strategy going forward. Wish you very successful investing. Thank you very much.